Hello everyone and welcome to today's webinar. My name is Kate Chalker and I'm a senior solicitor with the firm based in our Sydney office. Presenting today's webinar will be Adrian Bailey, who you can see on the screen. Adrian is the principal of our Sydney office, and I'm sure most, if not all of you, have come across Adrian before or seen him present one of our webinars or presentations that we hold. In today's presentation, Adrian will be taking you through family trust elections and also interposed entity elections. And he'll be speaking about when they're required, what are some of the issues that might arise through the use of them, and how do we make sure that we're completing them correctly. So just a bit of housekeeping before we dive in. The slides from today's presentation are available for download. If you haven't used the platform before, all you need to do is click on the Files tab on the right-hand side of the screen, and you'll be able to download a PDF version of the slides from there. But if you have any issues with that download link, don't worry too much, because they will also be included in the feedback email, which will be circulated later today. Also, if you have any questions which come to mind during the course of the presentation, please feel free to send them through. All you need to do is click on the chat button, again on the right-hand side of the screen, and you'll be able to type in your questions there. I'll be keeping an eye on them, and I can interrupt Adrian at an appropriate time to put those questions to him. So feel free to send any questions through. And then finally, just a reminder that today's webinar will be recorded and will later be uploaded to both our website and our YouTube channel. So just keep that in mind, not to disclose any confidential information when you're asking your questions. All right, so on that note, I think I will hand over to Adrian to get started on today's webinar.
Thanks, Kate, and hi everybody. Welcome to the webinar. I hope you enjoy it today. Like a lot of our topics and webinars, the topic today was suggested by one of the accountants that we deal with. So if you do, one of the questions in the feedback email is what topics you would like. So if you do have something you'd like us to talk about, make sure you put that down in the feedback email. Family trust elections and interposed entity elections. A bit hard to read on that slide with that picture, but that's what we're going to be talking about today. And in relation to the format of what we'll be discussing, first off, what are they? What is a family trust election? What is an interposed entity election? One of the requirements of them is that you choose a test individual. So we'll just have a little look at who to choose as a test individual and what then are the entities that form part of the family group. Go through why you would use them. So the main reasons that you would go to the trouble of putting in a family trust election, remembering that except in very limited circumstances, they are irrevocable. So once you have one in place, you're kind of stuck. So we'll go through why you would want to use them or why you might have to use them. And then what happens if you get them wrong, or if you have a family trust election in place and you make distributions to people that aren't part of the family group. What happens in relation to tax then. So jumping in to what they are. So relevant provisions themselves are in Schedule 2F of the 1936 Income Tax Assessment Act. If you're of a mind to go and read the Act one day, you've got to scroll all the way down to the bottom to get to Schedule 2F, but all of the provisions that are in there. So very briefly, a family trust election, or I'll shorthand it to FTE, is a choice by the trustee to be a family trust, and that is defined for tax purposes. An interposed entity election is one where you have an election to make an entity part of a family group. So that entity could be a partnership, could be a company, or could be another trust, or a combination of those. So in order for us to have a valid family trust election, there are 4 requirements that we must satisfy. First off, the trust itself must satisfy the family control test. And I'll go through what that means. We must specify a test individual. And as I mentioned before, unless very limited circumstances, you cannot change that test individual. So it's an important consideration as to who to choose. You've got to nominate a specific year from which the family trust election takes place. and it is one of those rare things that we can do in the tax world, where we can actually, in essence, backdate the election. Even though we're signing it now, we can nominate an earlier tax year in relation to the family trust election. Got to be a little bit careful in doing that. We have come across matters before where the wrong year was nominated, and the actual, for example, nominating, making a family trust election to make sure that they maintain some losses, but unfortunately they nominated the year after the losses were incurred. And the final requirement is that it must be in writing and in the improved form. So those are our 4 requirements in order to have a valid family trust election. In terms of the family control test and what that means is that you need to demonstrate that the trust is controlled by an individual or the individual and certain relatives of the individual. So there is a list of the relatives that you can look at for control. It's slightly different to what constitutes a family group for the test individual, but generally speaking, it's going to be things like spouses and children and parents and so forth. So how do we control a trust, or how does an individual or group of individuals control a trust? So that is, again, defined within the legislation, and it's that either you have the power to obtain beneficial enjoyment of the capital or income of the trust, the power to control the application of capital or income of the trust, or it's either of those are capable under a scheme of exercising such either power. The trustee acts in accordance with your wishes. You're able to remove or appoint the trustee, more than 50% stake in the capital or income. Beneficiaries are only the individual and certain relatives. So a lot of those are going to be fairly specific circumstances that they could only apply for. If we're thinking about a pretty standard discretionary trust, which our clients have in the stable, we're probably going to be relying on either being able to remove or appoint the trustee, or the trustee acts in accordance with the wishes to establish the family control test. Then we turn to, well, we need to nominate a test individual as one of our requirements to have a valid family trust election. So if we nominate a person, then the people listed on the slides become the family group. So these are all natural living people. They automatically become part of the family group of the test individual. So we have spouse, parents, grandparents, brothers, sisters of the test individual and their spouses, or their spouse, nephews, nieces, and children of the test individual or their spouse, lineal descendants of the nephew, niece, or child, spouses or former spouses of the family group, child of a former spouse, and a widow of a test individual or the family or a member of the family group. So it's a pretty broad range, but there are some slight strange things you can come across depending on who you nominate as the test individual. But it is a fairly broad range of people that would automatically be within the family group. We can also have entities that can form part of the family group, and they can be a trust that has made, the trust itself that has made the family trust election that's nominated to be part of the family group. Another trust which has made, so it should be an FTE, as opposed to and, nominating the same test individual. So if we have Adrian's trust nominates Adrian under a family trust election as the test individual, and then we have Adrian number 2 trust, which again nominates Adrian as under a family trust election. That trust, second trust, will be part of the same family group. An entity that has made an interposed entity election, a company trust or partnership where 100% of the entitlements are held by members of the test individual's family, or trusts that have made a family trust election nominating the same test individual. So an example of that may be a company in which, again using me as an example, a company in which I own all of the shares, I'm the test individual for the trust, that company would be part of the family group. Or if I had a trust holding the shares, if that trust made a family trust election nominating me, that company would be part of the family group. And then we have deductible gift recipients, so charities where you make a deduction, or charitable entities, I should say, where you make a deduction, or you can claim a deduction when you make a gift to them, and then entities exempt from income tax, so charities that don't meet the extra requirements of being a DGR. So all of those entities will be part of the family group, so they are things that we can distribute to from the trust, without breaching any of the Schedule 2F in relation to family trust elections. I mentioned before, and it's quite a little bit hard to read, hopefully it's a bit easier to read if you download the slides, who to choose as a test example. And we've got the example of Harry here. And say, for example, we choose Harry as the test individual for the family trust election. If you work your way through the provisions as to who would be part of the family group in terms of individuals, you'll end up with a chart like this. So you've got Harry, Harry's spouse, both their parents, both of their grandparents, siblings of Harry's spouse, siblings of Harry, nieces and nephews of Harry and his spouse, children of Harry and his spouse, and lineal descendants and their spouses, and so on. So, as I mentioned, quite a wide group. But if you look at it, and of course it's going to depend on the family circumstance, what we don't have included in this family group would be either cousins or uncles and aunts of Harry or his spouse. They wouldn't fit within the family group. A way that we might address that if we wanted to make sure that they were part of the group is, rather than nominate Harry, who's our main client, so to speak, as a test individual, if we nominated Harry's mother or father, in the example here on the slide, we've nominated mother, then his uncles, aunts and cousins will form part of the family group when you work your way through the provisions. We still have all of those other same people that we had in the previous slide. They would still all be members of the family group, but we've extended it to include Harry's uncles, aunts and cousins. Again, going to depend on the circumstances as to whether we do this or not, and likelihood of wanting to distribute to these people would be a relevant circumstance. Perhaps Harry looks after one of his aunts or uncles, but something to think about there. One of the negative of this approach, or a potential negative of this approach, is that when a test individual dies, we're then limited in terms of making further family trust elections in relation to that test individual. You can't make one for a person who's passed away. So that may mean if we're nominating Harry's mother or father, we're limiting the time frame from which we can then make further family trust elections with that test individual or interposed entities with that test individual. So that's a negative of this approach. Maybe we're required to do it so we broaden the net of potential beneficiaries under the family trust election, but we've got the negative of reducing the lifespan of when we can make further family trust elections.
Sorry, Adrian, I might just jump in with a couple of early questions. If you just want to go back to that last slide you were on.
Yep.
So what happens in that situation if Harry were to get divorced?
So a former spouse is still a member of the family group. If you get divorced, whether that's formally or informally, in terms of you go through the legal process, you're still part of the family group.
All right, I just have two more. If a family trust has made a family trust election and the trust owns all of the share capital of a company, will the company form part of the family group?
It will, yeah.
Okay, and last one at this point. In appointing a test individual, could you nominate the child of a parent to lengthen the list of beneficiaries, given that they may not be in control of the trust?
You can, and that would be a variation of what we've shown here in terms of nominating Harry's mum instead of Harry. It changes some of the potential beneficiaries, and again, kind of lengthens the lifespan. I guess the question then is, in terms of nominating that child, are we limiting things in the future in terms of future nominations?
Thanks, Adrian. That's it for now.
Okay, thanks, Kate. Interposed entity election. So we mentioned that if we make an interposed entity election, that entity will form part of the family group. So for a trust, I should say, that the entity has to satisfy the family control test before we make the election. For a trust, it's the same rules as the earlier slide in terms of, as I said, usually for a discretionary trust, there will be an individual able to change the trustee. For a company or partnership, the people listed or the entities listed below have to have 50% of the income or capital in order for it to be an interposed entity election. So the test individual one or more of the test individual's family, trustee of trust with family trust election with the same test individual, or any combination of those. Should be pretty clear from that, but say, for example, if we had a company where we had 3 unrelated shareholders, so it was a business being operated by 3 unrelated parties, we wouldn't be able to, and they each held 33.33% of the shares, we wouldn't be able to make an interposed entity election in relation to that company because we wouldn't pass the family control test. I mean, the question would be, why would the trust distribute to that company in the first place? But just an example there of something that we wouldn't be able to make an interposed entity election. So why would we use them? Really for the 5 reasons that are listed on this slide. It may be that we choose to use them, or we must use them to ensure that we get some form of, in essence, tax benefit. So with that, first one being to simplify the trust loss rules, much simpler to meet the trust loss rules if we have a family trust election. Ensuring the franking credits pass through if we're receiving franked dividends of over $5,000 in franking credits. Allowing a company to pass the continuity of ownership test. Again, coming back to losses within the company, our 2 tests to make sure we can use those losses or maintain those losses are the continuity of ownership test and the business continuity test, or the same business test in old speak. To bring it into the family group for family trust election purposes. So to bring something into the family group, we may use a family trust election or interposed entity election, or as part of the small business restructure rollover as a safeguard in terms of one of the provisions. And we'll go through all of these except for bringing another entity into the group, because that's fairly self-explanatory as to why we might use them. I mentioned a family trust election. If we make one in relation to a trust, it makes it much easier for us to meet the trust loss rules. So here we've got probably the most 3 common trusts that you will come across in practice. A non-fixed trust, a fixed trust that's non-widely held, so we don't have a large number of members, and a family trust. So a family trust is a trust that has made a family trust election. So in terms of the 4 different trust loss tests that we have to meet, if we have a non-fixed trust, which is a discretionary trust, it would fit the definition of a non-fixed trust if it hasn't made a family trust election. We have to meet all of those 4 tests. If it's a fixed trust but non-widely held, there's two tests we have to meet. If it's a family trust, we only have to meet the income injection test. So in essence, the income injection test is making sure that we're not injecting income into the trust from outside the family group. So if we are in the position where we have a trust with losses, to make sure we are able to maintain and use those losses in the future, it may be simplest to apply a family trust election. That way we only have to meet that income injection test in the future. The second reason to use a family trust election, as I mentioned, would be to make sure that we meet the continuity of ownership test. It may be the case that when you work through the provisions you meet it anyway, but it certainly makes it a lot simpler if in certain circumstances you won't meet them, but it makes it a lot simpler in a lot of circumstances if we make a family trust election to meet the continuity of ownership test. So this is where we have a company with losses. We want to make sure that we maintain those losses, and we don't meet the business continuity test for whatever reason, because that's our other alternative test. So in order to meet the continuity of ownership test, shares carrying more than 50% of the voting, dividend and capital rights must be beneficially held by the same persons for the test period. A trustee or a trust is not an individual, and in terms of that requirement under the tax law in relation to these provisions. So we can't meet that requirement if we have our shares held by a discretionary trust. If we make a family trust election for the purposes of these provisions, the trustee and the trust is treated as an individual for the purposes of the continuity of ownership test. So we will be able to meet that test if we make a family trust election. So that would be a second reason where we may be forced to make a family trust election. The last one I mentioned is the small business rollover, restructure rollover contained in 328G. So came in a few years ago now. In my mind, was it only a couple of years ago? It's probably more like 5 or 6 now, if not longer. One of the requirements is that an individual has the ultimate economic ownership in either the transferor trust or the transferee trust. So it's difficult to show that where we have a discretionary trust, because no one really has the ultimate economic ownership in relation to the assets of that trust. However, Section 328(440) tells us that this condition is definitely met if either the transferor trust or the transferee trust is a family trust. In other words, it has made a family trust election. So if we're doing a 328G rollover, it may be a good idea to make sure that we don't have an argument in the future about whether we're meeting this condition, that one of the entities makes a family trust election in relation to the rollover. So what happens if we get it wrong, or what can go wrong with family trust elections? So if we have one in place and we make a distribution to a person or entity that's outside the family group, we end up with family trust distribution tax. So that is taxed at 47%, so the top marginal rate, plus any levies that are relevant that year, such as temporary budget repair levy, Medicare levy. Any additional levies that are placed on for that particular tax year are also added to the 47%. It's payable by the trust or the electing entity. Where we have an individual who is trustee, it's payable by that individual. Where we have a partnership or a company that has made the election, if it's an interposed entity election, it's the partnership or company that pays it. If the trustee is a company, so the trustee of a family trust that is distributed to members outside of the family group, then the tax liability lies with the directors. So this may be a bit of a reminder there that if we have, for example, a trust holding all of the shares in a company, discretionary trust holding all the shares in the company of mum and dad's business, and we're declaring dividends out of it, and we make a family trust election so that we can make sure those dividends flow through, then in terms of making sure that we're minimising our risk, we don't have mum and dad there as directors of that trustee company, because if we get it wrong at some stage, and that could be inadvertently, then we'd have an issue there in relation to them being assessed, both of them. Now that I mentioned dividends, I'm not sure whether I went through, perhaps we've missed the slide, or I skipped over it in relation to dividends. So we don't have a slide at all. No, that's fine. So the other reason to make a family trust election is that if we have an individual who receives $5,000 or more in franking credits, and it's flowing via a trust, the way that the attribution rules work in terms of attributing, and the gross up rules in relation to attributing and grossing up that dividend in the hands of the recipient, is if it's going through a discretionary trust, we can't technically meet that requirement, and we wouldn't be able to flow the franking credits through the trust and then have them grossed up in the individual's name and applied back. So we have to make a family trust election in that circumstance if our trust is receiving more than if an individual is receiving more than $5,000 in franking credits, to make sure that the franking credits flow through that discretionary trust. Just a point on that, that's franking credits from all sources. So if we're getting $4,999 from family trust and $1 from other sources, we still would need to make a family trust election in that circumstance. A case study of what could go wrong in terms of family trust elections and making them. So here we've got, coming back to Harry, we've got the Dr. Harry group. We've got the Poodle Trust. And at some stage, a number of family trust elections have or haven't been made because the advisors have decided that they needed to be done. So we've got the Poodle Trust, and Harry is the test individual under the family trust election. It has made a distribution to Bones Proprietary Limited, all of the shares of which are held by the Collie Trust. And Sally, Harry's wife, is the test individual under a family trust election in relation to the Collie Trust. Bones has subsequently declared a dividend down to the Collie Trust, and hence probably the reason for making the family trust election at the Collie Trust, in that we wanted to make sure that we could flow the dividends through. And then the Collie Trust has declared a distribution of that franked dividend to the Fox Trust, which hasn't made a family trust election or an interposed entity election. So you come along, and this is a new client to you, and you pick up this study or this scenario, and you're having a look at it, and suddenly some alarm bells start to ring, or should start to ring, in relation to what's occurred here. And the main one is going to relate to really the Collie Trust. The fact all of the shares of the Collie Trust are held all of the shares of Bones Proprietary Limited are held by the Collie Trust. It's made a family trust election specifying Sally as opposed to Harry as the test individual. This means that Bones, if you work your way through the provisions, cannot be part of the family group. So the distribution could not be part of Harry's family group. So the distribution from Poodle to Bones is outside of the family group and potentially subject to family trust distribution tax. Now that can't be fixed because we can't revoke the trust election nominating Sally as the test individual for the Collie Trust. So we've got a bit of an issue there, clearly. And so then depending on who the trustee of the Poodle Trust is, potentially we've got some personal exposure there for the clients, whether they're the individual or directors of the trustee, and we're going to be getting taxed at 47% on that distribution, plus whatever levies. So fairly big issue there, depending on the size of the distribution that's been made and how many years it's been made for, because this may have been going on for a number of years. In the other secondary issue, which can be fixed, fortunately, is the distribution of the franked dividend from the Collie Trust to the Fox Trust. And we don't have it going anywhere from that, just for the purpose of today's example. But in relation to that, to make sure that the franking credits flow through down to the Fox Trust, we would need to bring the Fox Trust into the family group of Sally, as opposed to Harry. So we'd either need to make an interposed entity election for the Fox Trust or a family trust election nominating Sally as the test individual for the Fox Trust to make sure that we don't lose the benefit of those franking credits. If we do that, that then may further limit our ability to distribute from the Poodle Trust to the Fox Trust, because it won't be part of the same family group. So we've got a fair mess here. We've got one solution for one of them we can't fix. So then we've got to have a discussion with the client as to how we're going to address it. So a bit of a case study there in terms of how things can go wrong if we're not working our way through and making sure that we're thinking about who can be part of the family group. Doesn't happen a lot, thank goodness, but obviously clear that it's important that we make sure that if we are going to make a family trust election, which would be for one of those 5 reasons, so either wanting to maintain trust losses, company losses, frank dividends, restructure rollover, or bringing an entity in so we can distribute to it into a family group, that we want to make sure we work through who the relevant person is if we're making a family trust election, or if we're making an interposed entity election as well. And that's the presentation for today, Kate, if you've got other questions.
Yeah, I do have some questions for you. Firstly, just going back to some of the previous questions we had. If we assume that Harry gets divorced, what happens if his former spouse remarries? Does that change whether they're still included in the family group?
No, it doesn't. Yeah.
Okay. And another one of the earlier questions, if you have a discretionary trust that owns all of the shares in a company, do you need to make an interposed entity election to have that company form part of the group?
You would have to, because the discretionary trust, I should say, if the discretionary trust hasn't made a family trust election, then the company cannot be part of the family group. So you could either make a family trust election for the discretionary trust that holds the shares, or an interposed entity election for the company.
All right, next one. Apart from making a family trust election, are there any other restrictions on claiming trust losses from previous activity, for example, non-commercial losses?
Yeah, so I mean, there's a variety of what you call loss measures that aim to limit you from effectively artificially using losses. So maintaining those losses via the family trust election is only really one element of that. As I said, there are other tests as well that need to be applied.
Thank you. Next question, would it be right to say that all investment trusts need to make a family trust election to be able to pass through franking credits?
I never say it's right to say all, because until you're actually passing through more than 5,000 or an individual's receiving more than 5,000 in franking credits, you're better off not making it, because once you do it, you're stuck. And if you want to do something a little bit more inventive with that trust, you're going to have issues with family trust distribution tax. And by saying inventive, I don't mean some outrageous tax scheme or something. I mean, what if you want another family group to take over that trust at some stage? You won't be able to do it if you've made a family trust election and they're not part of the family group.
All right. Next one, I'll combine two questions into one. There's one member who's still a bit confused as to when you use a family trust election as opposed to an interposed entity election. And just also in relation to the family trust election, what are the benefits of making one as opposed to not making one?
So I guess probably the easiest way to say would be you can only make a family trust election in relation to a trust. So for a company or a partnership that you want to bring into a family group and you don't meet the requirements otherwise, you have to make an interposed entity election. So that's really the difference between the two. For a trust, you can make either an interposed entity election or a family trust election, but you can't make a family trust election for a company, for example. You have to make an interposed entity election. And sorry, Kate, the second one, what are the
pros and cons of making a family trust election as opposed to not?
Well, the positive would be if you're in that scenario where you want to make sure you maintain the losses or make sure you're meeting the 328G requirements. The negative is it's irrevocable for the most part. You're stuck in only then distributing to members of the family group from the trust. So to use an example, if we're in business and for whatever reason we want to distribute income to, say, key employees or something like that out of a discretionary trust, which technically you could do if they were a beneficiary, if we've got a family trust election in place, we can't without family trust distribution tax.
Okay, next question. If a family trust election is backdated, back beyond a distribution outside the group, would that create a problem?
No, and that's usually where you see them being backdated because people recognise that there's been, sorry, I'm revisiting that question in my mind, backdated back before, yeah, okay, that will create a problem.
Outside the group.
Yeah, that will create a problem because if your family trust election applies from the year that you nominate it, if you've in subsequent years, if you've made a distribution outside of the group, that'll be subject to family trust distribution tax.
Questions are flowing in now, Adrian. Just in terms of timing, when are you required to make the family trust election? Is it at the time of making the distribution or at the time of lodging the tax return?
You can make it at any time that you like. There's no requirement. It's just a question of what are we making it for. So the key point in making it is that you nominate the year from which it applies. So you want to make sure that if we're wanting to maintain losses, it's from the year before the losses are made. If we're wanting to maintain franking credits, again, it's a year before the dividend is made. But we can make it some years down the track if we recognise that we should have or need to.
Yeah. The next question references how family trust elections can be limiting in the future. Are there any provisions or any way to either vary or revoke a family trust election?
It's been a little while since I looked at it because they are very limited. My recollection is you can change it in very strict timeframes. If the test individual dies very shortly after making the election, something like that is one of them. But there are easy enough to say no. Once it's done, it's stuck. Because otherwise, then you have people. If you think of it from a policy perspective, if you made it that people are able to change the family trust elections, that would circumvent the purpose of them, because then you just change it to a different family group. So, in essence, think of it as if I make it, I'm stuck with it.
All right, next question we have, I suppose it's a bit more of a comment. If you put trusts under companies, so I assume if you have the trust owning all the shares in a company, this can cause issues given the need for a family trust election if you're trying to pass substantial dividends.
Yeah, that's true. If you're passing substantial dividends, you'll need to make a family trust election, but I guess the alternative would be what you put the individuals in there rather than the trust, and that limits your flexibility in terms of where you send it within the family group, because it would just have to go to the individuals. So yeah, it does complicate things, but it would probably still offer a better position overall in a traditional family group.
Next question we have, if you don't make a family trust election and you've got clients who are receiving dividends in excess of $5,000, they won't receive the franking credit.
Technically, yes, they won't. In the scenario where it's going through a trust, technically they won't receive the franking credit. Like many things in life, often that's not identified, but the reality is that in order to maintain the franking credits, you need to make the family trust election.
Next one, in your experience, do you know of the ATO imposing penalties for not having a family trust election and passing over $5,000 in franking credits?
In that scenario, they tend to take a bit more of a what you call an educational approach, because the reality is that you can always go back and make the family trust election sometime in the future, way back when, so to speak, in terms of backdating it. So what would normally occur is you'd identify the issue, or the ATO would identify the issue, you'd make the family trust election, and that would fix it. And I have had matters where we've approached the ATO, we've said, this is what we intend to do, can you confirm that this fixes the problem? They've come back saying, yep, that fixes the problem. In terms of the other aspect of penalties where you're distributing outside of the family group, it's the normal considerations in terms of those penalties. There's a recent case that's come out in the last couple of days by the name of WIDP, which revolves around a family trust distribution tax matter. So, it is something that they look at doing.
Okay, the next question, is family trust distribution tax self-assessed? And does the ATO check on who family trusts are distributing to?
Not generally, and my understanding is you have to tick a box on your tax return to say that a family trust election has been made. But there is no real background checking to make sure that you're meeting the requirements in terms of distributions. Pardon me, the information is going to be there because you have to nominate or you have to notify who the beneficiaries are and provide their details when you're doing the returns. But there's no real, in my experience anyway, no real proactive monitoring of that to make sure you're not inadvertently breaching it.
All right, I just have two more for you at this stage.
Mm-hmm.
So if a family trust election has been made, then the only real way to escape the limitations that you spoke about or to nominate another test individual would be to wind up the trust and create a new one? Or is there an ability to use a rollover or a restructure to get around that?
The way that's the way that the provision is worded in terms of family trust distribution tax, it doesn't just apply to income, it applies to effectively a transfer of assets as well. So you're a bit limited, but you probably end up winding up the trust in order, if that's the issue.
And if there is a family trust distribution tax, are you able to use money from the trust to pay that?
You can if there's money, and also there's a corresponding adjustment for the person who did pay the tax in the first place. So in our example where it went to the company and it paid tax on the basis that it lodged its return, that company would get an adjustment in its favour because the tax is taxed elsewhere on the basis you can't have double taxation unless you're dealing with super funds these days over 3 million, then you do. But that's another topic for another day.
I'll just ask one last late question, which is, what is the impact on the small business CGT concessions of making a family trust election?
No impact in terms of the small business CGT concessions. Doesn't make any impact on your eligibility or doesn't advance your eligibility in any way.
All right, well, thank you for answering all of those, and thank you everyone for all of your questions. If you do have any more questions which come to mind, feel free to call or email Adrian or I, and we can assist you with those. But otherwise, keep an eye out, please, for our feedback email, which, as I said, will be circulated later today. If you could just take a couple of minutes of your time to complete that survey. And as Adrian said, we really do take into consideration the topics that you're interested in hearing about. We will have another webinar in June, and we haven't decided on the topic or the date for that webinar. So we'll certainly keep in mind whatever suggestions you might put in that feedback email. So if you could complete that, that would be much appreciated. But other than that, we will let you get back to your Wednesday. Thanks very much for attending, and we hope to see you at the next one.